Ladies and gentlemen, welcome back to the channel. You may be shocked to see this, maybe even more shocked than I was, because Waller today, Fed Waller, dropped bombshells. I mean, I think Waller was really sent out today by the Fed to clarify some things about Wednesday. I think Powell and the Fed, seeing the reaction of markets and investors, as they're sending the wrong message. The Fed collectively is showing how incompetent they are. So what did they do? They sent Waller out today to clear the air and open up the optionality of a July Fed cut. You have to understand, before Waller spoke today, there was a 95-ish% chance of no cut in July. Waller actually came out today and says, we need to start the process of cutting rates. We, as in the Fed, is quote unquote data dependent, and the data says we should be cutting rates. Waller, it almost seems like he's like throwing disses at other Fed committees during this speech. Not mentioning anyone by name, obviously, but he's basically saying the other Fed members have no idea what they're talking about, historically speaking, when it comes to tariffs and what the Fed should be doing. This was definitely by far the biggest development today for markets, but I will share with you all of your other Tesla stock news as well. So we're going to start off with that. Instead of just sharing the headlines, in which we'll do in just a moment, I want you to actually listen to this clip from Waller. It's about 7 minutes long. You need to hear this.
To bring in Fed Governor Christopher Waller. He is joining us this morning from Washington. Good morning, Governor Waller.
Good morning, Steve. Thanks for having me on.
Thanks for joining us. I just want to begin big debate, and you can see it in the outlook for rates from the Summer of Economic Projections. Where do you stand in this debate right now over how much concern we all should have over coming potential inflation from tariffs?
Steve, as I've been saying for probably a year, I think the important thing for central banks to do is to look through tariff effects on inflation. This is a long-standing view going back 40, 50 years. So any tariff inflation we should see, and I've given various estimates that I don't think it's going to be that big, and we should just look through it in terms of setting policy and look at the kind of underlying trend of inflation. And right now, the data the last few months has been showing that trend inflation is looking pretty good, even on a 12-month basis. So I've labeled these good news rate cuts when, if inflation comes down to target, we can actually bring rates down. I've been saying this since about November of 23. So I think we're in that position and that we could do this and as early as July.
Do you think you could cut rates as early as July?
Well, I think that would be my view, whether the committee would go along with it or not. But I think we are in the position that the data's good. GDP growth is going to be near target, our long-run target in the first half of this year. Unemployment's at our long-run target. Inflation's running very close to target. Yet we're 125 to 150 basis points above where the median long-run neutral policy rate is. So I think we've got room to bring it down, and then we can kind of see what happens with inflation. If it got really bad and people got very nervous, you could just pause. But I think we're in a good spot right now for talking about bringing the rate down.
Would you want to begin a process of bringing rates down by 125 or 150 basis points now?
No, I think you'd want to start slow and bring them down just to make sure that there's no big surprises, but start the process. That's the key thing. We can start the process of bringing rates down, and then if there's some big shock due to maybe the Middle East conflict, we can pause. We paused back in January. We've been on pause for 6 months to wait and see. And so far, the data has been fine. There hasn't been any reason to, in my view, I don't speak for the committee or the chair, but I don't think we need to wait much longer, because even if the tariffs come in later, the impacts are still the same. It should be a one-off level effect and not cause persistent inflation.
So let's talk about this, difference of opinion with some on the committee. Obviously, the SEP showed that the forecast showed that 7 members don't want to cut rates at all. What is the urgency right now in your mind to cut interest rates? Why wouldn't you want to just wait and see what happens with tariffs and inflation in the coming months before you started cutting interest rates?
Right. So we've been on pause for 6 months, thinking that there was going to be a big tariff shock to inflation. We haven't seen it. We follow the data. That is what we do. We look at the data, and we should be basing policy based on the data. And as I said, if you look forward to if you think this inflation is going to hit in August or September, it doesn't matter. It's the same impact. It's just a matter of timing. And I've been arguing since a year ago that central banks should be looking through this. This has been debated for 50 years in central banking, and the standard rule of thumb is you look through these types of price shocks. And that's what I think I'm arguing that's what we should do. And so if that's the case, start moving on cutting the policy rate.
How can you be so confident, Governor Waller, that a rise in prices from tariffs won't spill over into other prices and cause a broader inflation problem?
Correct. And I think this is a valid concern my colleagues often have about the persistence increasing from this one-time price effect. And as I said, if you go back over the last 50 years, this was always the concern that central banks had when there was an exchange rate shock, an oil shock, a shock to the value-added tax. And the answer was, well, but the tariff's a one-time thing, or whatever the shock is. But then workers will try to increase their wage demands to make up for the higher prices. And that was always the source of the second round effects. But I just don't see that happening now. I gave a speech in Korea a couple of weeks ago where I laid out why I don't think this persistence will happen. Mainly the labor market's okay, but it's not strong like it was in 2022. So if you were to walk in today and you think inflation is going to be 6 or 7%, your employer is going to show you the door. They're not going to give you this huge wage increase to make up for tariffs that aren't even showing up yet. So I don't think that this wage mechanism is going to be around to cause these second round effects. And that's always the standard channel for generating persistence. I just don't think it's going to be there.
Do you have concerns now for the labor market? We just talked about the Philly Fed being negative in employment. You've had this modest rise in jobless claims and, of course, something of a step down, along with recent revisions downward to the employment levels. Do you have concerns for the job market?
Yeah, I'm watching it. I mean, it's solid. It's been kind of amazing. The unemployment rate has stayed right around 4.2 to 4.3 for a year, just hardly moving. But we are starting to see things. Like if you look at there was a story in the Wall Street Journal earlier this week that the unemployment rate for new graduates is at a 20 or 25-year high. College graduates are not finding jobs. Their unemployment rate is 7%. In pre-pandemic, it was 5%. So it's that kind of data that's starting to make me a little worried. We're seeing job creation coming down. We're seeing a lot of things like you just said with the Philly Fed that are suggesting that maybe the labor market's starting to soften more than we might want it to. And so in my view, if you're starting to worry about the downside risk of the labor market, move now. Don't wait. People love to talk about long and variable lags. Why do we want to wait until we actually see it crash before we start cutting rates? So I'm all in favor of saying maybe we should start thinking about cutting the policy rate at the next meeting, because we don't want to wait till the job market tanks before we start cutting the policy rate.
Now, also in the news today, the Iranian foreign minister arrived at the Geneva venue for talks with European counterparts. Again, just to highlight one of the quotes that also hit the newswire today from Fed Waller, says, the Fed has been on pause for 6 months, waiting for an inflation shock that has not arrived. It's not going to. Waller is finally, I mean, he's been on the bullish side, but he's finally like publicly almost criticizing the Fed, right? Criticizing his colleagues, saying, you know, even seven of them don't want to cut rates at all this year. He's saying basically, what's wrong with you guys? Like, we're supposed to be data dependent, yet, you know, we're getting good data and you still don't want to cut rates. I kind of felt like it was a diss towards his colleagues. Correct me if I'm wrong, but that's That's what it felt like to me. It almost feels like Waller is the only adult in the room that is not letting politics or overly dramatic opinions affect policy, right? Waller seems to be the only adult in the room here. I think the rest of the Fed is probably compromised at this point, either intellectually or, well, for one reason or another. Let's leave it at that. The Wall Street Journal reports today that retailers are raising the bar for free delivery or eliminating the perk as they seek to mitigate tariff costs, which again, yeah, retailers, companies, like you can't just pass on all the costs to consumers. So even then, tariffs are a one-time price increase. It's not going to be followed up by wages. I agree with what Waller said there. Like that seems like common sense to me. Wall Street just sees things a little bit too like by the numbers, but if you actually know anyone in the real economy, like people are not in a position to demand wages to go up. Okay, they're just not. We're not going to see that. Now, what companies are gonna be forced to do is sure maybe raise prices a little bit in some areas that you're able to. But for the most part, companies are going to have to find ways to raise margins internally to offset some of the tariffs, okay? Now, one way they can do that is implementing AI and actually laying people off. That's why I think tariffs could actually just be disinflationary or deflationary because we now have AI. I mean, if you are someone that answers the phones for, a company, let's call it, you can easily now be replaced. If that company is hit by tariffs for whatever reason, you're probably going to be replaced, dude. Like, that's why, again, you want to be investing in these great AI opportunities. That is what we are doing down below in the trading community. Link is in the description of this video if you guys want to join that. I bought another company today. I don't know how this stock is trading where it is, how low it is relative to SoundHound or some of your other, Big Bear AI, some of the other ones that people actually know about right now. I think it's only a matter of time before this one also blows up. Now, there was a new round of sanctions put on Iran today. This time, the Treasury Department targets entities procuring machinery for Iran. Now, head of FX research at Deutsche Bank says, quote, "The real story for the U.S. economy is the collapse in immigration, down more than 90% compared to the run rate of previous years, equivalent to a slowing in labor force growth of more than 2 million people." So again, Waller's the only adult in the room here because I think he understands this. I think it's pretty commonsensical, okay? Yeah, we have a collapse in immigration. So what does that mean? Well, the unemployment rate could rise pretty aggressively if companies stop hiring just a little bit, because the total pool of workers is not growing nearly as fast as it was before. Now, some big news today as well. The U.S. prepares action targeting allies' chip plants in China. It's kind of weird how this headline reads when it comes across the newswire. Yay! But yeah, anything that has to do with semiconductors and taking action, typically not seen as a good thing. Nvidia down about 1% today. Now it says the U.S. prepares actions targeting allies' chip plants in China. Move as part of broader export control crackdown on tech to China. The U.S. seeks to revoke waivers for Samsung, SK, and TSMC that allow them to use U.S. tech in Chinese factories without case-by-case licenses. Now, in a Fed report today, the Fed reports it is still early to assess tariff impacts on the economy. They say the tariff impact is yet to show up in the official data. Again, because it's not going to. Financial stability is resilient and heightened uncertainty. The report says that current Fed policy is well positioned for what lies ahead. In early April, Treasury market was functioning remained orderly, but liquidity fell to levels last seen in early 2023. Look at this. This Fed report says liquidity materially deteriorated in equity, corporate bond, and municipal bond markets. They even reference equity liquidity started to dry up. Putin says that Russia and China see a clear way for a new world order. Putin says, I believe there is resolution to be found for Iran-Israel conflict. Putin says Russia is not seeking mediation in the Israel-Iran conflict, but we have ideas. NVIDIA's CEO, Jensen Huang, says this is the decade of robotics and autonomous vehicles. I mean, let's be honest though, this is really the decade of AI. This is the decade of gene editing. This is the decade of innovations in healthcare. This is the decade of growth. This is not even just a decade. I think the next 30 plus years, AI, biopharmas, like gene editing. If you can't tell, I'm very bullish there. Mix gene editing with AI potential, or just AI in healthcare in general. It's probably going to be one of the biggest disruptors that Wall Street is not seeing at this point. That's why I think there's a lot of hidden gems in even biopharmas right now, specifically ones that are implementing aspects of AI. Nonetheless, topic for a different video, topic for the trading community, probably not for this channel. But this is a trend that's going to continue for decades. We are in a Cold War, AI Cold War, with China in every aspect of the name. Healthcare, enterprise, software, robotics, AVs, autonomous vehicles. In every aspect, we are in an AI Cold War with China. That is a great thing. That will force America to innovate at speeds in which you would have otherwise not seen, which creates value for shareholders. Why do you think partially I'm so bullish right now? Putin says if Ukraine were to ever deploy a dirty bomb against Russia, it would likely be their final error. Basically saying we would take you off the map. Putin asked if Russia is unreliable by not helping Iran. Putin responded and says those who say such things are provocators, which is true. I mean, imagine if Russia started to help Iran. Like, y'all want to talk about World War III? Like, there you go. That's a damn good start. Putin says that Russia supports Iran's right for peaceful atom. Yeah, that's probably not going to go over well with the West. Putin says that Trump promised to support our legitimate demands over the safety of Bashir's staff in Iran. Let me know your thoughts on all of this down below in the comment section. Ladies and gentlemen, hit the like button and subscribe to the channel if you have not done so already. Have a great rest of your day, and I will see you in the next one.